Welcome back. This morning, the PCE personal consumption expenditure, the measure of inflation was reported. It shows inflation continues to decline, which is good news. And we see articles now, such as on MarketWatch, PC inflation report revives talk of Goldilocks and soft landings. We're going to ask you a question at the end of this after looking at some historical data. Do you think they're going to manage this soft landing? And are we really in a Goldilocks situation? What's a Goldilocks? It says a Goldilocks report with good income, consumption, savings, and inflation. That's said by senior economist Dan North at Alliance Trade, by the way. And a soft landing occurs when the Federal Reserve is able to raise rates just enough to pull down inflation, but not too much to cause some sort of economic crisis. Well, today's report shows on a month over month basis in green, PCE personal consumption expenditure flat, year over year up 3%. Or PCE, which excludes food and energy, up 0.2%, monthly 3.5% year over year. We can see historically, month over month, and the yellow histogram bars were flat for the month. And we see this is the lowest low we've seen in actually quite some time. 0.2% on a core PCE. Again, core PCE excludes food and energy. That's a little bit higher, which shows us inherently that energy and food prices are pulling down inflation, which is good because food and energy probably represents the majority of our daily consumption. Not so much furniture or housing, things of that nature. In yellow, we see PCE year over year. In red, crude oil. Now, this crude oil chart is ratcheted to the beginning of the month when the PCE was indexed at, so to speak. So, nevertheless, we see a strong correlation. Crude oil is now moving to the upside as PCE is moving down, which tells us there are other components of the inflation report excluding crude, which are coming down quite significantly, and that's good news. Here we see the federal funds rate in black. Low interest rate environment is what got us into this inflationary trouble in the first place. Now the Federal Reserve has raised rates to 5.5% and kept them there for quite some time. We see inflation is now returning to the downside. PCE in blue on a year-over-year basis versus the S&P 500. Now, here's a cause for concern. There's a very strong correlation. When stocks go up, so does the PCE inflation report. And conversely, when stocks go down, so does inflation as well. Well, considering now inflation continues to decline, will this translate into lower lows on the stock market? Well, we could say lower inflationary pressures are better for corporations, but we really need to see those lower inflation rates sustained for quite a while in order for that to translate into better corporate earnings, to be sure. Now, there are two different major reports concerning inflation. PCE today and CPI. Consumer Price Indexes uses data from household surveys. It's more closely linked to what we would consider to be how consumer behavior. PCE sources their data from GDP reports and from suppliers, so it's a little bit disconnected. However, the good news is we can see over here in yellow CPI, red PCE, the current levels are very close together. There's not a lot of discrepancy between PCE and CPI, which shows us that the inflationary pressures we see are pretty consistent, regardless of whether we're getting it from suppliers and GDP reports or household surveys. The black histogram bars show us CPI divided by PCE. It's a flat top, which essentially shows us there's very little discrepancy between the two. Now, we see here in yellow PCE month over month, red core PCE excluding food and energy, both enjoying healthy declines to the downside. The core PCE excluding food and energy, meaning clothing and furniture and everything else, is a little bit more stubborn, but we see today's levels do still continue to mark a continuous downside, which is good. On a year over year basis, it's the same situation, a very nice, smooth, looks like a manageable decline in inflation, which is what we want to see. PCE in blue or PCE in red. Now, this chart is 2006 through 11. The question at the beginning was, will the Fed be able to manage a soft landing? Well, they did not manage the soft landing in 2008. We had 4% PCE and a little bit over 2% core PCE in 2007, 2008. Remember, 2007 was marked in part by very, very high oil prices, which is why we had such high PCE at that point. Federal Reserve did not rates fast enough, and that caused, in part, that huge financial decline. Now the question is, and we have, by the way, a black line over here. That's the Federal Reserve target. That's where we wanted to see inflation stop. It didn't stop at 2%. Well, fast forward to present day, we still have a 2% inflation target. The question now is, will inflation stop its decline at 2%? Will it mimic what we saw in 2008, 2009, declining to 1.5, 2% negative inflation, deflation? Or will it bounce from 2% and then, maybe hopefully remain near the 2 to 3% level, maybe a little bit below as well? That wouldn't be bad either. But ideally, we want to see inflation stay right near the 2% level. Question is, do you think that's going to happen? Or are we going to see a repeat of that hard landing in 2008? We hope this has been helpful. We look forward to seeing you back soon.